I don't think a gold confiscation would make any sense unless the government has to pay its bills in gold. The reason they had the 1933 confiscation was twofold. First of all, the economy ran on gold and the banks were being emptied because the government had too much debt. So people didn't trust the banks, they didn't trust the government, so they were withdrawing all their money in physical gold coins. So the wheels of the economy were not being greased because there was no gold in the system. It was under everybody's pillow. And the second thing was the government was paying its bills in gold, and the coffers were slowly emptying, so they wouldn't have had enough gold to pay the bills. We don't pay our bills. No government pays its bills in gold today, so why would they need your gold? So I don't think it's going to happen. I think it's unlikely.
Financial analyst and economic commentator Clive Thompson has issued a stark warning that the global monetary system is approaching a major realignment, driven by the mounting burden of unsustainable debt weighing heavily on fiat currencies. He points to Japan as a clear warning sign, where a deepening debt spiral is unfolding, with interest payments now exceeding government revenues, forcing the central bank into increasingly aggressive monetary interventions to maintain economic stability. Thompson draws a parallel with the United States, noting that while debt growth has temporarily slowed due to debt ceiling negotiations, the continuous rise in gold prices suggests that markets are anticipating the return of inflation and a deterioration in credit quality. In examining long-term trends, Thompson highlights a consistent pattern. Each time U.S. federal debt increases significantly, gold prices follow suit. This recurring relationship, he argues, reflects a broader erosion of confidence in fiat currencies. Investors, wary of inflation, fiscal mismanagement, and geopolitical instability, are moving capital into gold as a secure and time-tested store of value. This shift is no longer confined to individual investors. Global central banks have also ramped up their gold purchases, signaling a strategic pivot away from over-reliance on the US dollar and other fiat assets. The growing divergence between sovereign debt levels and gold's rising valuation points to a profound rethinking of monetary reliability. Thompson is particularly concerned with the abrupt, often unexpected, shifts in monetary regimes that have historically reshaped the financial order, such as the U.S. gold confiscation of 1933, followed by the 1934 devaluation. These events demonstrate how swiftly governments can disrupt fiat currency systems, unsettling markets and undermining investor trust. More recent shocks, including Switzerland's 2015 removal of the euro peg and Britain's 1992 exit from the European exchange rate mechanism, serve as modern examples of this fragility. Drawing on these lessons, Thompson envisions the possible rise of a bifurcated monetary system, where a new dollar or alternative currency linked to gold might emerge quietly but decisively. Such a development would mark a profound shift in global finance, signaling gold's potential return as a foundational pillar of monetary stability amid the unraveling of the existing fiat framework. Now, we present the clips from Clive Thompson's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think what's also going on is that large countries like China and probably India as well can see that the writing is on the wall for the present system that we have. In 1944, we had the Bretton Woods conference, and whether this was expected by the participants or not, what actually happened was the United States said, look, we've got the most gold. Why doesn't everybody go on to forget about a gold standard, which is very inconvenient because you're moving gold across the oceans with all the risks and work and costs. Why don't we go onto a dollar standard, and we will be willing to exchange your dollars and everybody's dollars for gold on demand. So the whole world in 1944 went on to this gold standard, or rather the dollar standard, which was effectively backed by gold. And that worked perfectly up until 1971, when more and more countries were saying there's too many dollars out there compared with the gold you're holding. Let's convert our dollars back to gold. Thank you very much. And so in August 1971, Nixon closed the gold window. It's sometimes known as the Nixon shock. And from that date on, the gold price traded freely. But of course, the fact was there was already a lot more debt out there than could have ever been serviced by the gold that the United States had. And of course, the gold price then took off and has barely looked back since. So, but the trouble is, we're now at the end of the road, I think, with the current system, and it's time for a new system. And a natural new system, in my opinion, might be some sort of gold-backed system. So whether that comes out of the BRICS nations, I'm suggesting a hypothetical situation, but let's say countries like China have a lot more gold than they say they have, which is a possibility. We don't know. And the BRICS nations get together and agree that they will have a monetary system backed by gold, of which China will be the holder of gold and issue all the renminbi, and everybody can, or maybe it'd be a new currency, it'd be the BRICS currency, and everybody will change their money backwards and forwards electronically, which is far more convenient than moving the gold around. But if there's a trade imbalance, that BRICS currency can always be converted back to the gold, which is held by a central bank for the BRICS nations. This could be coming, and of course it could be coming for the United States. So what would happen? Let's imagine some event happens tomorrow, and you wake up on Monday, and you suddenly have an announcement from the president, we're now on a gold dollar. And by the way, there's a temporary restriction on converting your old dollars to the gold dollar.
Well, I mean,
so
those
who've got the gold will be fine, but those who don't will be scrambling around to see if they can get some, because that's the only thing you'll be allowed to spend. Something is going on in the gold market that I don't understand and nobody seems to understand. And there's lots of speculation and theories, but if you look at the gold deliveries in COMEX, you will see that every month this year, they're at least 200% higher than the equivalent month last year. That means each month the deliveries are 3 times what they were a year ago. This month, which is May, we're only halfway through it, the deliveries are 700% higher than May last year. So someone somewhere is taking delivery of huge quantities of 100-ounce bars. That's 330,000 a bar. Someone is taking delivery of huge quantities of physical bars, and there's been all kinds of speculations to, one, who it might be or why they might be doing it, but we still don't have an answer, and we're months into this, but those bars are disappearing into some physical vault or somewhere who might in the past have been happy rolling over the futures on COMEX. They're taking delivery. Question is, who are they doing? Who is it and why? I don't have the answer. I can speculate to the heart's content and tell you all the theories, but some people say it's the US government stocking up on gold because they're going back on a gold standard. Some people say it's Canada who hasn't got any. Some people say it's Warren Buffett or Berkshire Hathaway because they've got billions and they've already made a few negative noises about the dollar and owning bonds. Some people speculate. Who knows? It might be Mexico. Nobody really knows. It might be a whole bunch of hedge funds all acting in concert. But whoever it is, first of all, doesn't seem to care that they're paying all-time record prices, and they haven't stopped. It wasn't a 1-month thing. It happened in January, but now it's February, March, April, May, and it carries on. I don't think a gold confiscation would make any sense unless the government has to pay its bills in gold. The reason they had the 1933 confiscation was twofold. First of all, the economy ran on gold, and the banks were being emptied because the government had too much debt. So people didn't trust the banks, they didn't trust the government, so they were withdrawing all their money in physical gold coins. So the wheels of the economy were not being greased because there was no gold in the system. It was under everybody's pillow. And the second thing was the government was paying its bills in gold, and the coffers were slowly emptying, so they wouldn't have had enough gold to pay the bills. So we don't pay our bills. No government pays its bills in gold today. So why would they need your gold? So I don't think it's going to happen. I think it's unlikely.
The current dynamics in the gold market present a compelling opportunity that mainstream investors have not fully recognized. Despite a sustained and significant rise in the price of gold, the equities of gold mining companies have remained undervalued relative to the metal's performance. This disconnect arises because many analyst profit forecasts, which inform stock valuations, are based on outdated gold prices and have not yet incorporated the recent upward trend in the metal's value. Even when using conservative assumptions, factoring in a gold price below current levels, earnings projections for a broad range of gold producers suggest much stronger profitability than market consensus estimates. This divergence results in abnormally low price-to-earnings P/E ratios for these companies, often below levels traditionally considered cheap, signaling that the stocks are trading at a significant discount to their earnings potential. Such a scenario tends to attract increased buying interest, particularly from quantitative and algorithm-driven investment strategies that seek undervalued companies with accelerating earnings growth, which should, in turn, support a rise in share prices. Clive Thompson highlights that this gap between rising gold prices and lagging gold mining stocks has persisted for years, creating an undervalued segment poised for recovery. As growth stocks show signs of slowing, investors will likely shift focus towards sectors that combine strong earnings momentum with attractive valuations, criteria that gold mining companies increasingly fulfill. The rising gold price directly enhances the profitability of these miners, reinforcing their investment appeal. This evolving landscape suggests that gold mining shares are well positioned for a rebound, with market valuations gradually aligning with improving fundamentals and a renewed wave of investor interest. Let's get back to the video.
The one thing which is going on is the gold price, and the gold price has risen way beyond the expectations of analysts when they last reported or last reviewed company results 6 months ago, 3 months ago, whatever it was. So what this means is that the profit forecasts of the analysts for the relevant gold mining companies are lagging the likely reality of what those profits will be. So if you factor in a gold price, maybe you can still knock $500 off for fun. So factor in, let's say, $2,800 for the gold price instead of the current price, which is currently 3,200 and something. When you put that in, and by the way, you don't have to do this yourself if you don't want to. Again, this is another exercise where you get AI to do it for you very quickly. You will discover that the expected earnings of these companies 1 year from now, 2 years from now, 3 years from now, based on that assumption of the current gold price or even a lower gold price today, is higher than the analysts are currently predicting. According to my maths, and I've worked out for a fair number of gold mining companies, there's lots of them where the price earnings ratio will next year be well below 10. And I'm talking sometimes,
wow,
6 to 9 levels, which is a very low price earnings ratio. It's a very cheap company. And that will be so let's assume the share prices don't rise. I mean, I think they will though, but let's say if the share prices don't rise, you will then have a very low price earnings ratio in a company whose earnings are growing very fast. Does that make sense? Doesn't.
Yep.
So what will happen? The share price has to rise because that's what robots do. They buy companies which are cheap with rising earnings. We don't have a lot of people investing in gold mining shares yet because they've gone through 12, 13 years of seeing these shares go backwards.
What's a good ticker symbol for gold miners? Use GDX or something else?
GDX is the mainstream ETF, which follows the large gold mining companies, and GDXJ follows the junior gold mining companies. That's an ETF. So if you look at, there you are. You've got the long-term chart there going back to 2009, 2010, and you can see that gold mining stocks are below where they were in 2010, yet the gold price is significantly higher. So they're just starting to take off. But I think what the real money hasn't arrived yet. The real money won't arrive unless or until, well, I would not going to say unless, I'm going to say until, because I think it's more of until there's a long-term pause in the mainstream large cap stocks, the ones which every fund manager, every investment manager is buying to stay in the pack, i.e. the Microsofts, the Nvidias, the Intels, the Googles, the Facebooks, and so on. So when those large cap stocks come to a pause, and I know we're sort of in an up and down phase at the moment, so it might be looking a little bit toppy, but we don't know that yet. It's too early to say for sure. But if they do come to a sort of grinding halt and stop rising, then investment managers are going to be looking around for something which is growing, both in terms of momentum, i.e. the share price going up, well, we've got that. In terms of earnings, we've got that. And in terms of being cheap, well, we've got that. So the gold mining stocks meet those three criteria. So I think that's where the opportunity arises is at the moment. But, just to sort of say every moment in time, there's always something out there which looks like an opportunity.
Increasing government debt levels and growing economic uncertainty are steadily eroding confidence in traditional fiat currencies, prompting a significant movement of capital into gold as a trusted refuge against inflation and market volatility. This trend is not limited to individual investors. Central banks worldwide are also accumulating gold reserves, signaling a strategic shift away from reliance on fiat money and the dominant reserve currencies. History shows that when monetary systems face stress, whether through currency devaluations, sudden policy changes, or shifts in exchange rate regimes, trust in paper money can rapidly deteriorate, triggering sharp financial realignments. Given these recurring patterns, it seems increasingly likely that gold will re-emerge as a fundamental pillar in the global monetary system. This could lead to the development of new financial frameworks or alternative currencies tied to gold, designed to provide greater stability and confidence in an era marked by persistent fiscal challenges and questions over the sustainability of current currency arrangements. That's it for today. Share your thoughts on Thompson's analysis in the comments section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.